My name's Charles Hadlock. I've taught for many years a course in valuation, and I thought I'd talk just briefly here about what valuation is for any students that may be interested in studying it or anybody else out there who's has an interest in valuation and corporate valuation. Okay, so there's lots of different cases in finance where we want to know what something's worth. What is the value of a stock, a set of loan repayments? What is a firm worth we're thinking of buying or selling, or a fraction of a firm we might buy or sell? Maybe we're thinking of buying a piece of commercial real estate and we want to know what that's worth. Okay, so it's useful to know the value of an asset. In some sense, any business career, you're helping a firm increase its value. And so knowing what value is and how it's measured can be very important, but it's particularly important for careers in investment banking, private equity, management consulting, where you're thinking about or giving advice on restructuring firms or buying or selling shares or entire firms, where you really want to get a sense of what something's worth, either recommend to a client or to make your own decision on whether to buy or sell something and at what price. So when we talk about the value of an asset, it's kind of a loose word, value. In some senses, what someone would pay for an asset, what would be the market price for an asset was put up for sale, what's the fair value for the asset. It's this idea of what someone would pay, what the market price would be if a market's functioning efficiently, where people have good information, where no one's desperate to buy or sell. The common way to think about the value of an asset is we invest in things and buy things and sell them because we think we're going to get some money down the road. And so it's essentially the sum of the value of all the future economic benefits, which are the cash flows of an asset, converted into today's dollars. Okay. So to do that, we first of all need a way of predicting what the future cash flows are going to be, and then we need a method to convert those cash flows of an asset in the future into today's dollars. Okay. So to do valuation, you've got to get pretty familiar with cash flows, and so there's the language of a lot of business is accounting, where accountants have rules of recording what you made or lost in a given period. To do valuation, you have to convert what the accountants said you made or lost, the profits, into actual cash flows, and they're not always the same thing. When a customer takes delivery of a good, the accountants will treat it as revenues, but you may not get paid from that customer to some point down the road. And so to do valuation, you've got to get familiar with accounting and understand the difference between how to adjust accounting numbers to the cash flows that are available for investors. Okay. Once you're familiar with that, then you need to think about how to predict the cash flows in the future. You can look at the current accounting statements and convert those into cash flows that are relevant. But then you also have to think about a crystal ball. So we'll talk about predicting future cash flows. And there you need to think about the economic model of a firm. How big is the market the firm is in? How much will it grow with the economy as a whole? What is the competitive position of the firm to figure out future revenues? And you have to think, what will the firm's cost be over time? Will they go up with inflation? If the firm gets bigger, will its per unit cost go down because of economies of scale? How much do you need to reinvest? Do you need to build a new plant in a couple of years as the firm grows? And so you have to write down an economic model of the firm, and that's called creating a financial model. You can take an entire course in financial modeling, but it's basically creating a crystal ball that's grounded in economics. We can check your assumptions, and typically you'll use a tool like Excel or other similar computer tools to build out then those future predictions and make sure they're all sort of internally consistent. Okay, so once you have an estimate of the future expected cash flows of a firm, the one main valuation approach is called the DCF, or discounted cash flow approach. You take each of the future cash flows that your model predicts, and you say, let's adjust those to today's dollars. So first of all, we know money is worth less tomorrow than today just because of interest rates, even without any risk. That's called the time value of money. Secondly, we know risky money tomorrow, and investors demand a higher return, so they're going to discount a risky dollar down the road a lot more than a safer dollar. And so you have to adjust those future numbers for both general interest rates and risk. And then the notion of risk that investors care about is somewhat subtle, because they care a lot more about risks that have to do with the economy as a whole than about random risks that might happen to a firm, like a factory blowing up, which also often investors, since they own 500 stocks, can sort of diversify away. Okay, so you take those future numbers, you learn these tools to discount for risk-free interest rate plus risk. You add them all up, all the future numbers, you convert them all to today's dollars and add them up. That's then the DCF valuation, and it's theoretically the right way to value a firm. Now, in doing that, there's obviously lots of assumptions, and those assumptions can be wrong. And so people often also, and it's very popular, value assets using a multiples approach, which is sort of a shortcut, but it sometimes does a better job. And so you say, look at, if my firm looks just like another firm that sold, and that firm sold for $100 million, my firm should probably be worth $100 million. Now, it might be there's no firm just like yours, but there may be firms that are similar to yours. They're just bigger or smaller. So you might be in a neighborhood and all the houses are selling for $200 a square foot. None's quite the same size as your firm. Some are bigger, some are smaller. But if they're all selling for 200 a square foot, you take your your house size, multiply by 200 a square foot. You have a rough idea of what your house might be worth. We do the same thing with firms. If we look at a whole bunch of other firms and we know their stock values or what they're being sold for as a multiple of revenue, so instead of price per square foot of a house, you're doing the value of the firm divided by its revenues. Maybe you get an average in a set of similar firms in the same industry of 5. And you say, okay, most firms are selling for 5 times their total revenues. My firm's got 100 million in revenues. It's roughly going to be worth 5 times 100 million or 500 million. Now, there's lots of different choices. You can do revenues, earnings, EBIT or EBITDA. If it's a hospital, you might look at the valuation per beds in the hospital. So there's lots of different denominators, and the key is you're trying to find some sort of unit that is directly proportional to the current and future cash flow streams of a firm, and you're assuming that your firm and all these firms you're comparing to are very similar. Okay, just like when you're valuing real estate, you want to look for houses in the same town or even better in the same neighborhood. Okay, so there's lots of important valuations. When you're valuing a very high priced asset, you're typically going to do both these approaches. And with each of the approaches, there's lots of different choices. And so the hope is you value many different using many different multiple methods. You do DCF valuations under various assumptions, maybe some conservative, some more aggressive. And you look at the effect on your valuations to look at a valuation range. In that process, often you don't have to make all the choices on your own. If you think your firm's going to grow on average with the economy, well, you'll look at economists' consensus growth rate for GDP. You don't need to do that on your own. And then you look at a set of ranges, and you it's an art more than a science to sort of pick the exact number, but hopefully with enough choices and with whenever there's an inconsistency, diving deeper into the models, you get to a valuation point you're quite comfortable with. And so if you're interested more in this sort of thinking, if you're a student, I'd encourage you to take a course. And if you're in industry or just someone interested, there's many good resources on the web and also some good textbooks. Thank you very much.